Yeah. Yeah, it would be too out of the ordinary. And I always forget something. Yeah, fun. Yeah.
So much.
This is something. Yes, achievement.
Yeah, I kind of want.
How did you? Kennedy, I was home because 11 as well.
Okay, folks. At this point, I don't think you need reminders. Things are happening, and you know that a week from today is the final project. And if you're going to sign up for the early final, I'll set up a spreadsheet. So the early final will be on the 12th, which will be next Thursday, from 10 to 12 in the morning. But the regular final is scheduled 2 weeks. Okay, so today we're going to complete our discussion of dividend policy. Now, I don't know how many of you have had a chance to try this on your company, but I said the starting point for dividend policy is to look at how much cash has been returned by a company in the form of dividends and buybacks. It'll be different for different companies, and how much could have been returned, potential dividends. I know we use the word free cash or equity, but it's just a fancy word for how much could my company have returned? How much cash is left over after you met every conceivable need. So you start net income, subtract out net capex, subtract change in working capital, and we have debt payments to the extent that if debt cash inflows and debt cash outflows, factor them, and you come up with free cash flow. So for every company, that's where we start our comparison. Now your company might be one of those very unusual companies. So what gets paid out on average, might not be every year, but on average, is roughly equal to what could have been paid out. I'll tell you the kinds of companies you're most likely to see. If you're looking at a utility, which lives on dividends and essentially can predict its potential dividends very well, Con Ed pays out like 98% of free cash flow equity. But for most companies, there's going to be a mismatch. Either the company pays too little in dividends or returns too little cash or returns too much cash. I know where your company will fall, but let's trace through what to do if you discover that your company has a mismatch. Let's start with the company pays too little in cash. If it pays too little in cash, guess what you're going to see? You're going to see a big cash balance. That's the other thing I'd look at. If you see big cash balances in your company, it means your company is holding back on cash. Then the follow-up question becomes, you trust managers. Keyword is trust. You trust managers with your cash. And let's make this less abstract. Would you trust Twitter's managers with your cash right now after what's happened over the last month? You say probably not. It's a subjective judgment. Obviously, there's going to be no consensus, but it's going to depend on how well you pick projects, how well I've done in terms of delivering returns. So I'm going to look at your history. And I'm going to look at two things. One is, have you delivered returns that exceed your cost of capital? Now, we did this already in the investment analysis section. The other is, how well is the stock done? If the stock has gone up 30% a year for the last 5 years and the market's going up only 8%, you're more likely to trust the managers because they've done well. And if you trust managers, you're going to give them the flexibility to accumulate cash. There's a reason why the big tech companies are able to get 100, 150 billion, $200 billion cash balances and not get any pushback. I mean, what do you have to complain about? If you've invested in Amazon over the last decade, you're not sitting there saying, I wish.
I'm looking over my shoulder.
Who has got their mic on? Could you
You
please?
got it.
So if you trust managers, and that's why when companies complain about the stockholders are putting pressure on us to return cash, it's usually a reflection that people don't trust. If you don't trust managers, either because they've taken bad projects in the past, or their story is broken, or the stock is not doing well, obviously you're going to demand that you get the cash back. I agree, you're just being prudent. You're just saying, I don't trust these guys with my cash. I want my cash back. And the key word is my cash. Shareholders shouldn't be begging companies to give them their own cash back. And that's a position that often happens in a lot of companies. Companies act like it's their cash, and you as a shareholder are demanding your cash back. How dare you? So that's if you're paying out too little in cash, accumulating your cash. Some of your companies, so you're going to see the exact opposite. You're going to see these companies returning more cash than they've available. Why do they do that? Either because everybody else in the sector is doing it and they feel the urge that they have to do buybacks or pay dividends, or because they're increasing their debt and making themselves more indebted. There again, I'm going to ask a follow-up question. How much damage are you doing to yourself by returning too much cash? Remember, when you return too much cash, what happens is you can't take as many projects as you used to, which is not a problem. If your project's a bad project, I'm perfectly okay with that. But if you're returning too much cash and you have good projects, you're doing double damage to yourself. First, you're digging a hole for yourself by returning too much cash. And second, you're rejecting projects you otherwise could have taken. So companies that have good projects that are returning too much cash, the obvious thing for them to do is reduce the amount of cash return. But we're going to talk about the practical problems you can run into trying to implement that, because once you start returning cash, especially dividends, it becomes very difficult to step back. We'll talk about how you might be able to frame that decision. But those are companies who are going to say, return less cash. And I'll give you the worst possible combination. You have a company that's returning too much in cash, so they have a dividend problem, but they're also taking bad products. See the problem you face here? Your first reaction is cut dividends. But what are you afraid of what they're going to do? They're going to cut dividends and take more bad products. This is a company whose dividend problem was born out of its investment problem. Taking bad projects, that's creating a dividend problem. And if they don't fix the investment problem, fixing the dividend problem is going to be cosmetic because it's going to keep coming back. So I think of it as in a framework. When you look at a company, think of putting it in a matrix. In fact, take your 5 companies and put them on this matrix. This matrix has 2 dimensions. First is looks at the quality of projects. You have good projects or bad projects. And you might use something like return on capital minus cost of capital to make that judgment. The second is, are they returning less than their free cash or equity or more than their free cash or equity? These are cash accumulators. These are companies that are burning through cash. If you're a company with great projects that accumulates cash, you get maximum flexibility. Those Googles and the Apples up there, because they have maximum flexibility. If you're a company with poor projects accumulating cash, you're essentially going to find significant pressure building up on you from shareholders. And these are the companies that the Bill Ackmans and the Carl Icahns like to target. If you're a company which is paying out too much cash and has poor projects, you have an investment problem, and you have to fix that if you really want to fix your dividend problem. And finally, if you're a company with good projects that's paying out too much cash, there you've got to find a way to reduce the amount of cash return so you can get back to taking good projects. Your company's got to fall somewhere in the matrix, and you might find that all 5 of your companies bunch up in one section because you pick companies within a sector, and often they share the same characteristics. Any questions about the framework for assessing dividends? Of course, your company could have negative free cash flows equity and continue to pay dividends. It still falls in that framework. It's returning more than its free cash flow equity, You got to figure out why they're digging a hole. Let's deep into it even deeper. So just to give you some examples. Remember I talked about Microsoft accumulating cash in the 90s, 96, 97, 98. In fact, by 2003, Microsoft had the largest cash balance in history up to that point in time. In fact, to give you a sense of how much cash balance increased, their cash balance was $43 billion, which was the largest cash balance any company had accumulated up to that point in time. And of course, if you look at what Apple did in the subsequent 20 years, it kind of blew through that 43 billion. And I actually went back and looked at every equity research report I could find on Microsoft in 2003 to see if anybody was complaining about the fact that they were accumulating cash. There wasn't a single complaint. It looked like they were getting a free pass. The reason is very simple. Microsoft went public in 1986. I think its market cap at the time it went public was $6 billion. By the time we get to 2003, that had become $250 billion. So if you're a stockholder in Microsoft, nothing to complain about. This is a company that had never gone back to the market after 1986, had found a way to use retained earnings to grow, and had taken projects that deliver 30, 40, 50% returns on projects. In 2003, investors felt completely comfortable letting Microsoft keep the cash. But to show you how quickly things can change, in 2004, Microsoft paid a special dividend of $33 billion in the last quarter of that year. Largest dividend paid in history up to that point in time. See what changed? Why did this company go from feeling no pressure to pay dividends to paying out this incredible dividend? And the answer lies in the news stories that happened in 2003. In 2003, the Justice Department targeted Microsoft with antitrust laws, saying that there was actually talk of breaking up Microsoft into Office and Windows. There was a threat of legal action, the stock price had dropped, and all of a sudden, these stockholders who had complete faith in managers found that fate shaken. What I'm trying to say is companies earn the right to accumulate cash, but if they're not very careful, that right can very quickly disappear. 2009, 2010, Apple had already accumulated a huge cash balance, but there was no pressure. Steve Jobs was still on top of the company. 2 years later, Carl Icahn had targeted Apple to return more cash. What changed? Steve Jobs had passed on. You had a new CEO, Tim Cook, that people didn't feel as much faith in. And to give Apple and Microsoft credit, they responded. Now, when you as a company find that investors don't trust you with the cash, you know what most companies do? They fight. They say, you're wrong, you have to trust it. But trust is not something you can talk people into. If you're a company that's lost trust, what you've effectively got to do is respond and then go back to building trust up. That's what Apple's done since 2012. It's gone back to building up trust. And today, Apple said, we're going to stop buybacks. And Apple has bought back $500 billion of stock in the last decade. 500 billion, think about it. And still managed to increase the market cap. I don't think Apple will have any trouble, holding back on cash because of what they've delivered to their shareholders. One final example, Facebook historically has felt no pressure to return cash. I think you're going to find significant pressure build up on Facebook to return cash. It's going to be difficult to get them to change. Why? What about corporate governance at Facebook makes it difficult to put pressure on them? The fact that voting rights are disproportionate, that Mark Zuckerberg controls 57% of voting rights. You see how everything traces back to corporate governance. If corporate governance is weak, you're going to see cash accumulation get larger in companies because it's very difficult to get them to part of the cash. So what I'd like to do is actually go back and use my company as lab experiments. And I want you to play a very unique role. I want you to play the role of shareholders in this company. And with each company, here's what I'm going to do. I'm going to play the role of top management. Remember, this is all about trust. I'm going to present you with the facts on dividend policy. I'm going to present you with the facts of how much cash have accumulated in the company. Then I'm going to ask you a question. Do you trust me with your cash? So let's start with Disney in 2003. Disney in 2003 was still run by Michael Eisner. And Michael Eisner had already had a history of treating shareholders like crap. So I've treated you like crap over the last 17 years because I felt powerful, right? So remember, you bring that history in. And here's what the facts look like in 2003. Between 94 and 2003, Disney had generated $969 million in free cash flow equity every year. So they could have returned $969 million every year. They actually returned $639 million a year. So every year they're holding back $330 million. Remember, if you do that every year for 10 years, even without interest, that accumulates to $3.3 billion. So if you look at the collective cash balance they had at the end of 2003, the cash balance was about $4 billion. So they've held back cash, the cash balance is built up. But here's the flip side of it. Between 94 and 2003, they generated return on equity 2% less than their cost of equity. They were taking projects that delivered accounting returns that were less than the cost of equity. So maybe the market, maybe the accounting numbers are off. The market returns are also not good. The Jensen's alpha for Disney in 2003 was negative. You're taking bad projects, the stock is not doing well. And I'm going to get up in front of you. So this is 2003, the annual meeting. I get up and I say, do you trust me with your cash? With that track record, you're going to say, why should I trust you? You're taking projects that deliver less than the cost of equity. My stock is not doing well, and you're asking me to trust you with the cash. You can see very quickly why in 2003 there was a pushback against Disney's dividend policy, saying, give us that cash. And the fact that it's Eisner who's run the company and he's not treated shareholders well adds to that pressure. I mean, this is why CEOs, when the companies are doing well, need to treat their shareholders fairly. Because if you don't treat them fairly, when you're doing badly, it's going to come back and boomerang on you. It's going to make it more difficult for you to change policy. So the bottom line in Disney here is, in 2003, at the end of 2003, Disney had a weak hand. It had a weak hand because they'd taken bad projects. They were run by an imperial CEO. And to make things worse, they'd done this really big acquisition in the middle of Cap Cities ABC, where the CEO said, trust me, I know what I'm doing. And it turned out that he didn't. So at the end of 2003, I would have expected Disney to face significant pressure, and it did, from shareholders because of its history. But remember, I said things can change. The end of 2005, the middle of 2005, Eisner stepped down, and Bob Iger became CEO. And at least initially, what did he do? He changed the way the company was run. He made it less centered on the CEO, created a board that was more responsive. And between 2004 and 2008, he actually returned more cash than he had available. So he actually was making up for the past. He turned it around in terms of project. The return on equity in project went above the cost of equity. The stock price started to outperform the market. The Jensen's alpha was positive. So at the end of 2008, 2009, when Iger gets up in front of the shareholders and says, trust me with the cash, you can see why he has a much, doesn't mean that everybody's going to agree, but you have a much better shot of getting shareholders to go along with you if you play a strong hand. And the strong hand comes from taking good projects and delivering good stock returns. Which brings me to 2013. So between 2009 and 13, Disney returned to accumulating cash. In fact, and it continued to earn a return on capital above the cost of capital. And in 2013, Disney had big plans. They wanted to build a Shanghai. Disney did significant expenditures coming through. Now, Disney's Plus was not even a glimmer in their eye, but they had big plans on expanding into Latin America. Would you be willing to go along? Probably still. Again, as long as you maintain good performance. If Bob Iger got up and said, look, I'd like to keep accumulating cash because we will have good investments, he's likely to succeed not guaranteed. Now Disney 2022 is in a strange place, right? Is anybody looking at Disney for their project? Probably not a great idea because we're doing Disney all through the class. But it's down about 45% over the last couple of years. It was up as high as 200, now down to like 110. And you've been reading about what's happening to Disney in the news. And Bob Chapek, who's the new CEO, clearly has issues with people around him because they're leaking like crazy. New York Times had an article where clearly insiders were speaking up about it. I mean, right now, Disney is in a very, very, very vulnerable spot because they need cash to build up Disney Plus. But at the same time, I think they're in a place where they've lost the trust of shareholders. So it's going to be really interesting to see what Disney does over the next year, because I think they have to deal with this disconnect that they have now between having to accumulate cash and people not trusting them with the cash. Any questions on how Disney is evolved? So 2003, 2009, 2013, 2022, you can already see the same company going through. You don't get the right to accumulate cash in perpetuity. You earn the right for the next year, the next 3 years, the next 5 years, but you got to keep. I mean, think of it as a trust as essentially a bank account, where every year that you do well, you're making deposits. Every year you do badly, you're drawing down. You need to have good years to make those deposits to be able to survive the bad years, because otherwise you're going to very quickly see pressure build up. Take it. Yeah, go ahead.
So I have a question. How does this play out from practical perspective, right? I mean, say, you're the CFO of Disney, and you've been paying out dividends based on your analysis over the last few years. So how do you see the pressure?
So what do you want to do? Cut dividends or increase dividends? You're paying out too much or too little. Let's see what the base problem is.
Okay, so let's say we're paying out too little, right?
Easy problem, right? That's an easy problem to fix. Paying out too little, you go to buyback, you have to decide. First, you want to return more cash, whether you want to pay out more dividends or buy back stock, and that's going to depend on how much you want to get stuck with. But if you're paying too much, then what's the first place you're going to cut? You've got dividends and buybacks. What's the easiest thing to cut? The one with less cost? Buybacks. And that's why, in fact, when you look at company buybacks, companies often announce buybacks with a whole lot of fanfare. It's in the Wall Street Journal. We're going to buy. You know that 80% of companies don't actually buy back all the amount of shares that they announced up front. Because when you announce that you're going to pull back from buybacks, the reaction is not as negative as cutting dividends. So depending on what your problem is, there's different paths to go. I thought the question you were going to ask me was, how does the pressure show up?
Right. Yeah.
It shows up in subtle ways. Institutional investors, and the companies know when institutional investors are not happy with it. You know how they know? A lot of selling going on. Old-time investors are leaving the company. But it really rises into a crescendo when you open up the Wall Street Journal and see that Carl Icahn is talking about it. You don't want Carl Icahn talking about your company. This is not a good place to be, because you know what's going to come after that. Is when he buys shares, he brings a whole host of institutional investors with. So when people are not happy with what's going on, and you can feel the pressure in either explicit or implicit. Any other questions? Let's move on to my second topic, Vale. So I'll cut to the chase. I compare Vale's free cash flow to equity, big negative numbers. Why iron ore prices have dropped, so they're not doing well. So if I stop right there and say, you're a company with big negative free cash flow to equity, what should you do? The answer is, hey, you should probably cut back on returning cash. But in the case of Vale, that's not what's happened. They've been returning huge amounts in cash, and much of it in the form of dividends. 80% of that cash return, perhaps even higher, came from dividends. So you can clearly see that this is a company that's returning too much cash. So here,
The average numbers.
it's the average. It's actually the average numbers. What I do actually is aggregate them over the period. It's actually simpler than averaging. Take the 10 years or 5 years. Don't do it for 1 year, but strange things can happen. Take a 5-year period. You can either use averages or aggregate numbers. Either way, you're getting a sense of, is it typically or what's happening. So what's your first reaction? Vale should return. That's cash, right? So you play the role of Vale shareholders. I'm going to be Vale CFO, and I'm going to get up and say, look, we're returning way too much cash. We can't keep doing this. We're digging a hole. We'd like to cut dividends. Sounds like a pretty logical thing to ask for, right? But there's a catch here. I don't know whether you remember, but early on in this class, we talked about Vale's voting structure. You've got common shares and preferred shares. And I said that the common shares are held by 8 or 9 entities, most of it is the Brazilian government, there's BNDES, there's a few private equity entities in Brazil holding it. But you and I, when we bought shares, bought those preferred shares. Preferred only in the sense of we got a dividend, but what did we give up in return for? We gave up voting rights. So who am I begging for that I want to cut it? I'm asking you're the preferred shareholder, say, hey, I'd like to cut your dividend. And if you're sensible, what are you going to ask me in return? You know, let me cut dividends just because I don't have enough cash. You're going to say, give me voting rights. You can cut it. You see how for companies like Vale, you're faced with this rock and a hard place. You want to cut dividends because you can't afford to pay them, but to cut dividends, you got to give up voting rights. It becomes a choice of control and survival sometimes. And guess what many companies put front and center? They'd rather stay in control than give up voting rights. So what happens at companies like Vale is you keep paying these dividends you can't afford to because you don't want to give up voting rights. And over time, you essentially create this monstrous dividend policy that almost destroys you as a company. I'll send you a link to a post I wrote about Petrobras, probably 8 years ago or so. Petrobras, of course, is a Brazilian oil company that briefly became the largest market cap company in Latin America, $200 billion market cap. And it did it there by going out and finding oil in every part of Brazil. And so it peaked, I think, at 200 billion. And over the next 5 years, it dropped from 200 billion back to 100 billion. It lost $100 billion of market cap. So I wrote a post about how Petrobras, remember all the things we talked about in the investment principle, the financing principle, and the dividend principle? Petrobras almost had a perverse version of each of those principles. It read the investment principle as saying, go and take projects that earn a return less than your hurdle. It looked at the financing principle to find a debt mix at its worst possible mix for you. And then it looked at the dividend principle that we should be returning cash, we can't afford it. So if you look at Petrobras, you can see it almost deliberately destroying value. The reason for it is actually very simple. It goes back to what your objective is as a company. Petrobras, in spite of being a publicly traded company, was treated as a government company. It was still run through the Ministry of Finance in Brazil. And guess what the minister told the CEO? I want you to make Petrobras the largest oil company in the world. That was the mission. It was not to make Petrobras the best oil company, the most valuable oil company, but the biggest oil company. And the CEO took it to heart. So you explored for oil, even though you knew that it wasn't viable. You kept borrowing money because you couldn't afford to issue equity. And you had to keep paying those dividends because the Brazilian government did not want to give up control. I mean, they could have driven it to zero if they kept going. Luckily, there are scandals that prevented that from happening. But you can see how companies can get at these destructive paths and not be able to get out of it because they face the choice of, do you want to pay a fair amount of dividends or do you want to give up control? Yes.
What are ways to cut the dividend without eroding shareholder?
I'm sorry, what?
What are some ways to cut the dividend without destroying like shareholder confidence? Or are there any?
I mean, think like a shareholder, right? You have no voting rights. And you get, and the reason you accepted that was I gave you this preferred dividend. I said I'll give you this. I can't think of a way in which you would accept a lower dividend without demanding something else in return, right? So I'm not sure what you can give shareholders or you can afford to give shareholders that would compensate them for not having the voting. So I think control has to be given one way or the other to those shareholders if you really want to touch it. Now, there are governments that actually end up with these strange policies. Luckily, there are relatively few governments out there. I think it was one of the Latin American countries actually imposed a required payout ratio. It actually mandated a payout ratio. Every company in the country which has earnings has to pay out 40% of its earnings as dividends. Why? Because they wanted to collect taxes paid on dividends. We can already see that imposing one payout ratio across the board is kind of a bludgeon. But I want to ask a question about what kinds of companies are going to be hurt the most. So take a market, you have large companies, you have small companies, you have growing companies, you have mature companies, you have money-making companies, you have money-losing companies. I pass a law that says 40% of your net income has to be paid out. Which of these four groups of companies is most likely to be hurt by this mandated payout? Is it large companies making huge profits? Probably not, right? You can pay the dividend, you can, if you needed to, you can go out and raise capital. That's not a problem. What about small companies losing money? Remember, the law is 40% net income. If you're losing money, it doesn't even apply to you. High growth companies that are losing money, again, if you're losing money, it doesn't affect you. But think of high growth companies making money. I make you pay 40% of your net income in dividends. You're saying, what's the big deal? They're high growth companies. They might have net income, but their free cash flow to equity can be negative. Why? Because they have huge capital expenditures, huge growth reinvestments. When you pass dividend mandates, the companies you hurt the most are young growth companies, and perhaps your most successful young growth companies. You know who pushes for these laws? Companies like to shed crocodile tears about this is terrible government, but the big companies making profits like this because by doing this, you're essentially killing the competition. So when you see things attached to dividends, you got to be very careful. It's not something that affects all companies, but it affects subsets of companies. So governments that force every company to pay dividends doesn't make sense. But there's another group of mandates that you're increasingly seeing talked about even in the US. One of the big reasons why Congress is talking about restricting buyouts is if you restrict buyouts, it means more money can get invested in companies, right? If you don't return that cash, it can get reinvested. Implicit is a belief that reinvesting money is a good thing and not reinvesting money is a bad thing. So if I mandate that every company has to reinvest 80% of its net income back into the company, sounds like a good thing, right? A lot of reinvestment going on. Would you want GM reinvesting 80% of its net income? I don't think so. What about GE? What about Kraft Heinz? What about Coca-Cola? Mature companies whose businesses are essentially either dying or declining. What's the point of forcing everybody to reinvest the money into bad projects? They say, what's the damage done? That money needs to get out of those companies into the hands of investors who can invest in other companies that potentially could do more good with the money. Mandating either required payouts or required reinvestment is a terrible idea. But governments keep talking about this all the time. As if you can apply a bludgeon on dividend policy. Which brings me to British Petroleum in 1992. I was actually at BP in 92 talking to a group. They pulled together 20 engineers, brought them together and said, hey, teach them corporate finance over a couple of days because we want these people to move up the ranks. So right now, it was the best, easiest class ever because these guys could, the math was as trivial for them, so they coasted through the class. But the company that I used to illustrate my the corporate finance principles, not Disney, but BP. So I got to the dividend policy section. I computed the free cash flow equity for BP, and this is between 82 and 91 of 571 million. As to how much dividend can a company with 571 million in free cash flow equity pay out, the answer is 571 million, right? But every year for a decade, BP managed to pay $1 billion more in dividends than their available free cash flow equity. How do you do that? Well, in the case of BP, the answer is very simple. Every year for that decade, they went out and borrowed $1 billion.
New rooftop parks just opened in New York.
Every year for a decade, they went out and borrowed $1 billion. There was one year, I think it's 1986 or 87, they actually had an IPO, very ill-fated IPO, where actually the investment bank guaranteed a price to the British government, and it turned out the stock prices dropped after they made the guarantee. In those days, they actually made the guarantee by 2 or 3 weeks ahead of the pricing. And in a pathetic show, the investment bankers went to the British government and said, could you let us out of the guarantee? We really didn't mean it. Thank God the British government stood firm. But that year they raised equity. So every year they basically had $1 billion deficit to make up. To cut the long story short, by 1992, BP was the most highly levered oil company. It had a dividend policy that essentially was unsustainable. So if you looked at it and said, it's obvious what they need to do. They need to cut dividends. And they actually did. You know why they ended up cutting dividends? Not that somebody came to their senses. They cut dividends because when they went to the bank in 1992 and tried to borrow money, the bank said, no more. You're already the most levered oil company. We can't keep lending you money. They did. They cut dividends. We all agree that this is the right thing to do from a corporate finance standpoint. But the day they cut dividends, you can see the headline. BP shares plummet after dividends are slashed. What do you think is happening? Remember how I described dividends? That you get the shareholders you deserve, that if you pay big dividends, you get shareholders who like big dividends. BP in this 10-year period accumulated the strangest, weirdest group of people ever called shareholders in a publicly traded company. For lack of a better term, they attracted every dividend addict in the world into the company. There are people who are addicted to dividends. They went to BP. So in 92, what's BP doing? It's going in front of a room full of addicts and saying, I'm going to pay you less dividends. It's not going to work. And essentially, at least initially, what did those people do? They celebrated and said, this is the right thing to do. They sold their shares. Now, to complete the story, 6 weeks later, BP share price had recovered. But in that 6-week period, much of the top management lost their jobs, as they should have, because they put off dealing with this problem for way too long. Like one of the first lessons when it comes to dividends is don't wait until the action is thrust upon you. Do it while you still have control as a company to cut dividends, because if you're forced to cut dividends, you lose all degrees of freedom. The brief periods in this 10-year period, BP thought the problem would go away. Every time oil prices go up, you can see BP managers celebrating. So no more oil problems, no more dividend problems, dancing on their desk. But every time oil prices went back down again, problems came back. So once you dig this hole for yourself of returning too much cash, especially if you pay dividends, it gets very difficult to step back without major pain to the company. And that's why managers are so reluctant. You think 6 weeks later, the stock price recovered. That small consolation to the top management that lost their jobs. And so you can convince managers that this is the right thing to do, but often they're not willing to take that. So I want to talk a little bit about if you're a company that needs to cut dividends, how you can frame that dividend decision in a way. But it might not be, people might not be happy, but at least it makes it more palatable. So let's say you're a company, remember that telecom company that things have changed and become a technology company? So they're great projects, who wanted to invest the money. If you can somehow figure out a way to package your dividends with some kind of investment opportunity out. So Disney last year or 2 years ago, when the enthusiasm about streaming platforms was maximum, it come back and said, you know what? We're investing billions of dollars in content for the streaming platform. We would like to reduce the amount of cash we return because this investment is out there. My guess is that they could have gotten away with it. I don't think they can pull it off now. But if you can bundle a dividend drop with something that you can present shareholders, that you can do with the dividends. Because if you just have a dividend cut, no matter what you say to shareholders, they're going to believe the word that something bad is happening in the company, your stock price is dropping. So this study actually looks at what happens when you cut dividends with nothing. It's just because when earnings drop, no, or with an, if the stock price drop is negative for all three cases, and what have I gained? When you bundle it with good investment opportunities over time, you find that you recover. But if there's nothing else out there, the drop after dividends continues to persist for weeks or months after the dividends. So if you're going to have a prompt, just like the debt policy prompt, it's better to have too little debt than too much debt. The same thing is true with dividends. Better to hold back on dividends than to overcommit on dividends and then have to come back and reverse that decision. So we talked about two of the companies I've analyzed, two that British Petroleum we haven't looked at before, but let's look at another company that I haven't tracked in the class, but used to be a high growth successful company in the 1980s, the Limited. Leslie Wexner, who founded the Limited, was a merchandising genius. He basically invented the mall store, or the way we see it today. Along the way, he picked up companies like Abercrombie and Fitch and kind of built them up into, you might have seen the Netflix special on ANF, but basically it's a company that was growing through much of the 80s. During the 1980s, we looked at the free cash flow equity, the Limited, because it was growing so fast, it had negative free cash flow. And again, the common sense, if I asked you, how much can a company with negative free cash flow equity return? The answer is probably nothing, right? But they were returning about $41 million. You're saying, how does a company, that's a young growth company with negative cash flows, end up paying dividends? I'll tell you the story that probably got them started. You're a young growth company. You have negative cash flows. You can't afford to pay dividends. I'm your investment bank. I show up at your office and say, look, guys, if you don't pay dividends, there are some shareholders who cannot buy your shares. Is that true? There are actually some pension funds that cannot invest in companies that don't pay dividends. There are fewer and fewer left. But there is a certain number, certain group of investors who will not buy shares in companies that don't pay dividends. So here's what I suggest. I suggest you pay a token dividend. In fact, the Limited started by paying $1 million in dividends in 1983. If you pay a token dividend, you're going to make it on the list. It increases your potential demand, your stock price will go up. Sounds alluring, right? But you see the danger of following that process. You pay a token dividend. Who do you attract? Dividend addicts. This is like offering an addict a little bit of cocaine. Can you please stop now? Doesn't work that way, right? If you attract people who like dividends and you offer them a token dividend, guess what they want next year? More dividends and more dividends. Don't open the door if you can't afford to do it. And this would be general advice to any company in negative free cash flow equity. Don't go out and start paying dividends. Don't even start buying back stock because other people are doing it and for all the wrong reasons. If you can't afford to pay dividends, don't even open that door to returning cash to shareholders. Yes?
At what point do you know you can pay a dividend and sustain it?
Well, you can track your free cash flow equity every year. You can track, right? So the first year you're positive free cash flow equity, you're probably going to hold that. Why? Because you want to make sure that it wasn't something you need. If 3 years of positive free cash flow equity row and your cash balance is starting to accumulate, then I think the signals are building up that now you can afford to return cash. You still have a choice of whether to return it in dividends or buyback. Initially, you might do just buyback. It gives you more flexibility. But the more you can maintain those positive free cash flow equity, and the less you read, it turns out that your growth is usually the indicator. As your growth starts to level off, you want to see a free cash flow equity accumulate. Yes.
If you have a company that has no future prospects, then
No future, so it's in a bad business.
yeah, it's a liquidation scenario. In that case, we should try to maximize return.
Absolutely, right? So if you look at the future, there's no reinvestment needs. You can return 3 times your free cash flow equity every year, because what are you trying to do? You're trying to make your company smaller over time. You're liquidating partially each year. That's what paying our dividends. That's why You might look at your company and say, this company is returning more than its free cash or equity, but it's not a problem. It's a fossil fuel company. And I think it's going to have to get smaller over time. Tobacco companies, returning more than your free cash or equity might be the right thing to do, because where are you going to go with all that cash? You're essentially shrinking the company and perhaps making it go away with that. Your sustainability experts are not going to like it, but who cares what they think? You're a tobacco company. Why would I want to sustain you? What are you going to do being a sustainable tobacco company? And there's no business left there. Might as well leave. Which brings me to my final example. We've talked about Tata Motors all the way through this class, and I've emphasized that it's a family group company. The reason I emphasize that is when you're a family group company, you have a choice of either doing what's best for your shareholders or what's best for the family group. And I said, if you're a family group company, often what's best for the family group takes precedence over what's best for the shareholders. So keep that in mind as you look at Tata Motors numbers, because Tata Motors also has a free cash or equity dividend like Vale. It's returning more cash than it can afford. Its dividends exceed its free cash flow. If Tata Motors were a standalone company, I would probably say, you should probably move, cut back on dividends, pay less. As a family group, I don't know what the family is trying to do here. Maybe it's trying to take the cash out of Tata Motors and put it into Tata Consulting Services and of reinvesting across the family group. That's the problem with investing in companies that become part of the family group, and the decisions of a company then become part of this portfolio that the family looks at of all the companies within the group. It's terrible for your shareholders because you can see that the company is doing things that are destructive to you. But this is what you give up when you have no control over a company. That's what often happens with family group companies. The dividend policy, the two keywords are trust and then the corporate governance issue, right? How much do you trust managers and how much power do you have over them will determine whether you can in fact even change dividend policy. So if I were to sum up in my matrix, here's what I would have. Baidu is a company which returns no cash, but that's okay. They have good projects. Nobody's going to put pressure on Baidu to return more. Disney, Vale, and Tata Motors are returning more cash than they can afford to, but they have good products. So at least at the time that I did them in 2013. Since then, Vale has probably gone into this quadrant of the matrix, because over the last 9 years, those of you who track Vale, it's had serious issues in terms of how the company is run, social costs created, the backlash from legal costs. So Vale has probably gone in there. But Disney is, I think, getting dangerously close to the line where it loses trust, and you're going to find itself, it's going to find itself under significant pressure, especially after the last 2 years. So when you put your company in this matrix, it's at least giving an indication of what to do next. Whether it's practical to do it, might be, so if you're looking at those and say, how do you get out of this problem that you're paying dividends you can't afford to? There might be no easy path. But not making that decision leads to what happened at the team, which is it'll build up over time. It's not going away. And when it's forced on you, it's far worse than when you do it yourself. So you can either, you can build your own spreadsheet, but it's not a big deal. You can use mine. Again, don't do it for 1 year, do it over 5 years, compute the free cash or equity every year, compute the dividends and buybacks every year. Then go back and look at what you computed as debts and salaries for your company. Go back and look at what kind of accounting returns does this company have, return to capital versus cost of capital. All of those things would feed into the judgment call you make. And you might say, look, the company has a lot of cash, but we'll leave it alone because it's done well, it's accumulated trust. It's got a lot of cash, it should return more cash. That's if you're a company that's accumulated cash. But the company that's depleting cash, you might say, look, that's okay because it's a declining business and depleting cash is fine here. Or you might say, look, they should stop depleting cash because they have good projects and need to reinvest money. So any of those recommendations might play out, but which one will depend on the company you're looking at. Yes?
How does, how much debt they have and risk of bankruptcy?
That's actually a very good question, because when you're under levered, what do we say companies should do? Borrow money and return cash to the shareholders, right? So if you've done the capital structure section, concluded the company's under leverage, you might actually make the argument that this company should be returning more cash than it has available because it's one way of reducing equity over time. So tie your dividend recommendation to what you found on your capital structure as well, because they're connected. In fact, they're all connected, right? The investment, the capital structure, the dividend policy, all have links to each other. In the investment section, you look at how good the projects were. The financing section, you look at whether they were under or over leverage. The dividend section draws on the first two because you can't make a decision purely based on it. Yes.
So in this case, we're looking at free cash flows over the past 5 years. But what if we've got a beta and Johnson's alpha that's looked at over the past 2 years of data? Does it matter?
I don't think so. Trust is, I mean, basically, the only reason there's no consistency issue, it's trust. So the question you might ask is 2 years enough to build trust? You know, at least in markets, people have short-term memories. Disney used to do well until 2020, but people have forgotten that already because the stock price is down 40%. So in a weird way, you might want to make the Johnson's alpha more short-term because markets forget very quickly, but the accounting returns more long-term because there is more ups and downs with net income and return on equity and return on capital. So don't let consistency drive how long you go back to do your Johnson's alpha. Any other questions? Now, there's another way, of course, you could set dividends, and it goes back to how we thought about capital structure. Look at what everybody else in the sector is doing. And you can look at dividend yields or dividend payout ratios to make this judgment. You can expand it into buybacks into a cash payout ratio. So it's completely flexible. But whatever you're doing, you're comparing what your company does to what the rest of the sector does. So if you take Disney, its dividend yield and payout ratio very similar to what the sector is paying, at least on that. We'll come back and take a deeper look at the sector, but it's actually very close. Vale has a higher dividend yield than the sector, but a lower payout ratio. And you can see that almost every company in the sector has this payout ratio issue because commodity prices were down. It wasn't just Vale that ended up with a payout ratio greater than 100%. It's pretty much every company in the sector. If you look at Tata Motors, looks like it's paying out far less than the typical automobile company. It looks at least like it has a lesser cash return than a typical automobile company. I won't read much more into it because you can say maybe that makes sense, doesn't make sense. But in spite of paying out more than its free cash on equity, it actually ends up with a yield and a payout ratio lower than the industrial. And Baidu pays no dividends. Not the entire sector looks a lot like Baidu. Tiny dividend yields and very little payout ratio. In the sector where nobody pays dividends. And finally, with Deutsche Bank, it's insane. Its dividend policy is just out of control. Payout ratio 362%. On every dimension, it looks like Deutsche needs to cut back on dividends. It really can't afford to pay the dividends. That's very good. So I took a close look at the entertainment sector from which I got the average. There were 17 companies in my comparison. Only 7 paid dividends. Already you can see that this is a very mixed sector. There are small companies that don't pay dividends and big companies that do. So if you're looking at just dividends, you might say, look, I want to look at only the bigger companies in this group. It's perfectly okay. The average looks very close to Disney, but you can see a wide divergence across. Now remember, whenever you have a wide divergence across numbers, it's good to think about why there are differences. What causes these differences? And from a fundamental perspective, you'd expect high growth companies to pay less dividends than low growth companies. Maybe companies with a lot of debt can afford to pay more dividends than companies without debt. So I'm going to do what I did with my capital structure, which is to look at differences in yield and payout ratios across companies. I went to the whole market there, but the entertainment sector is far too small to run a regression. So I've run a regression of yield and payout ratios across the companies. Before you get too excited about the regressions, the R-squares are pretty low. There's a lot of dividend policy I can't explain with fundamentals. But one of the ways you can use this, if you take Disney's numbers and plug them into these regressions, and basically you can see the variables I've used are beta. My hypothesis is riskier companies should pay less in dividends than safer companies. Growth, higher growth companies should pay less in dividends than lower growth companies, and how much debt they have. Or I'm kind of agnostic because you can use debt to pay dividends. Higher debt ratios can increase dividends, but can also be a risk factor. all of the variables are statistically significant. The R squared is low, but I can use that regression to get a predicted payout ratio. In fact, I did. I plugged in Disney's beta, Disney's expected growth, and Disney's debt to cap ratio. I got a predicted payout ratio of 27% and a predicted dividend yield of 1.4%. There, if you look at what they actually do, they pay less than my prediction, but close enough that I can look at the regression and say, given how other companies set dividend policy, it looks like Disney's well in the norm. This is, again, it's not as powerful as looking at free cash flow equity. You're just looking at the peer group and making a judgment. But you might want to look at your peer group, the same peer group on which you collect data. You might want to also look at what their dividends look like, just to get a sense of the real company, what other companies are doing. And because that can be their defense, right? They say, we don't pay enough dividends, but nobody else does either. It's a very difficult argument to overcome because companies want to be so much like that peer group. They feel safe. Any questions on dividend policy? So we've kind of come full circle, right? We've talked about the investment principle, the financing principle, the dividend principle. And through all of this, we've said we want to maximize the value of the business. But notice along the way, we've never actually talked about valuing the business. So I'm going to close this class off by bringing it all back to valuation. So let's talk about valuing the business, putting a number. I know some of you are in my valuation class, and this will be a repetition of what you've seen in that class early on. But there are three ways you can put a number on a company. The first is to do an intrinsic valuation. What is an intrinsic valuation? You value business based on its cash flows, its growth, its risk. And a discounted cash flow model becomes the tool we use to assess intrinsic value. The second is what I'm going to call relative valuation, but the word I prefer to use is pricing. In pricing, what do? You attach a number to a company based on what other people are paying for similar companies. So think of buying a house or buying a ticket on StubHub to a Yankees game. You base it on what other people are paying in that section. Say, how much should I pay for that section? That's price. And the third way you can put a number on a business, and this is uncommon, relatively small stuff, that is if you have a business where cash flows are contingent on something happening, you can use an option pricing model. I don't want to be mysterious, but if you're valuing a young biotech company with a blockbuster drug working its way through the pipeline, it's not made it through yet. You're not buying a traditional set of cash flows. You're buying a set of contingent cash flows. Contingent on what? If the drug gets approved, you could be worth billions, but if it doesn't, you're worth nothing. An option pricing model. So we're going to keep the option pricing model out of the discussion because really that's for another class and another discussion. But let's focus at least on intrinsic value because it ties back to everything we've talked about in this class. Now, when we think about intrinsic value, we often think about big spreadsheets. But I want to bring it back to basics. When you think about what drives the intrinsic value of a company, it's really four sets of inputs. The first set of inputs capture how much cash flows you're getting from your existing investments, existing assets. You already made investments, I don't know, you've earnings, cash flows. What are those cash flows? That's probably the easiest input of them because you can get that out of financial statements. The second big input that drives your value is the value of growth. Growth by itself is not good or bad, it's just there. Because growth has two sides. The good side of growth is it makes your small revenues to big revenues, your small earnings to the big earnings. The bad side of growth is you have to reinvest to get that growth. And already you can see that if you reinvest too much to get growth, you can end up destroying value while growing. If you reinvest very little to get that growth, you can add value. If you reinvest just the right amount, you might end up doing nothing to value, even as you get to be bigger. That's a much tougher input because you're looking into the future, trying to get a sense of what kind of business am I in? Can I earn such? The third question I want to ask is how risky is your business? In a discounted cash flow model, there is only one place to show risk, and it's the discount. Let me repeat that again, because a lot of people try to bring risk in multiple places. In a discounted cash flow valuation, the only place it shows up is in the discount. What kind of risk? Everything. Operating risk, financial risk, country risk, it's all in. And finally, when you value business, just like with some projects, with cash flows can continue forever, you can't estimate cash flows forever. So you get closure by assuming that at some point in time in the future, your company will become a mature company. What's a mature company? A mature company is one that grows at a rate less than or equal to the economy. What does that accomplish? If you have cash flows growing at a rate less than or equal to the economy, you can assume it can maintain those growth rates forever. The minute you do that, you've essentially made your life easier, because when you have cash flows growing at a constant rate forever, if you remember, we have that present value equation for a growing perpetuity. We use that to capture the cash or the terminal value. So I'd like to come back and talk about these inputs, but before I do that, any questions on those inputs? Yeah.
I've seen, I think, some APV papers somewhere where they were trying to bring in, as you mentioned, the risk into the cash flows. And would you call that, like, do you think that's completely wrong, or is that?
Tell me how you bring risk into the cash flows, because there's a lot of people who think they bring risk in. So if I ask you to bring risk into cash flows, tell me what you do.
To be honest, I got very confused after that, and I left it at that.
I'll tell you what most people do. They take probabilities, they take scenarios, they take an expected value. And they say, because I've taken an expected value across all these outcomes, I've risk adjusted the cash flow. You have it, right? Because that's just an expected value. That's what we're always supposed to use. Risk adjusting the cash flows requires that have you ever watched Howie Mandel's Let's Make a Deal? Terrible show, but watch it anyway, right? It's kind of a very simplistic show. Here's how it works. You have two suitcases up in front. One has $1 million, the other has nothing. You're a contestant. Howie calls you up front. And he gives you a fixed amount of money to walk away from the deal. So what's the expected value of the deal? If it's $1 million in one suitcase and zero in the other, then expected value is $500,000, right? Howie starts offering you $300,000, $350,000. Because guess what? If you're a rational person, you're going to accept less than the $500,000 because you get it guaranteed. That's called a certainty equivalent. If people want to risk adjust cash flows, here's what they would need to do. They need to project out the expected cash flows in Coca-Cola. And then after they have the expected cash flows, they have to play let's make a deal with each cash flow. So your cash flow in Coca-Cola is $1 billion next year. There's risk in it from Russian operations and Indian operations or wherever else they operate. Say, how much would I accept as a certainty equivalent? It'll be less than $1 billion, it might be 750, 800, depending on how risk averse you are and how much risk you see in the cash. If you're willing to do that, then you don't have to risk adjust it, discount it. You can discount at the risk-free rate. Certainty equivalent cash flows discounted at the risk-free rate will give you the same value as taking expected cash flows and discounting at the risk adjusted. In fact, Warren Buffett has been quoted as saying, he's often quoted as saying things he never said. Like 30 years ago at a meeting, somebody asked him about betas, and those of you who heard Warren talk about betas, he hates them. He says, I don't like the CAPM. And then he went further. He said, I don't risk adjust my cash flows. These were when T-bond rates were 5%. I wonder whether he's changed his mind. He said, here's what I do. I take cash flows and discount them back at the risk-free rate. And I still hear from people who remember that quote saying, how come you're risk adjusting the discount rate? Warren Buffett does. Then I asked them, do you know what Warren Buffett discounts? He discounts what are called owner's earnings, but he counts only the portion of earnings that he can count, that he believes can be delivered. In other words, anything speculative, and you can put quotes around it, he doesn't count. He's effectively doing a version of certainty equivalent cash flows by looking at only the earnings that he believes can be delivered by this company. Don't do both. If you take conservative cash flows and risk adjust the discount rate, you're now double counting risk. So make your choice up front. Are you going to risk adjust the discount rate? Are you going to risk adjust the cash flows? And risk adjusting the cash flows means using lower cash flows than expected. And once you made that decision, stick with it, because when you do both, you end up double counting risk.
Quick follow up on the certainty equivalent. Yeah. Could you remind us how does the discount rate
Okay, remember how we got the extra risk premium in the discount rate, so if you take your cost of capital of 8%, right now the T-bond rate is 2.8%. There's a risk premium in there of 5.2%, right? With the 8% minus 50. If you take your expected cash flow and discount it back at 5.2%, in other words, you're taking the same risk premium that you used to put in the denominator, you will actually get each year a certainty equivalent cash flow based on the same assumptions that drove your discount.
So the ERP factors that.
Exactly. The ERP, the default spreads, the debt ratio, all factor in, and then lower your expected. Because you need something tangible, right? You can't do, I'll just keep haircutting the cash flow till I feel comfortable. Because God only knows where you feel comfortable. You might take off 50% of the cash flow. You're very. So this allows you to bring in all of the technology we built to adjust discount rates into adjusting the cash.
So beta times ERP is what is haircutting
It's more than that, right? Because it's it's cash flows of firm, it's cost of capital. So basically what I would do is computer cost of capital, just like you would in a traditional discount rate, subtract out the risk-free rate from it. That difference will include ERP, it will include beta, it will include debt ratio, it will include cost of debt. Use that to reduce your expected cash flow every year. And you'll have certainty for it. I think that's what the contestants on Let's Make a Deal do. I can see them working out there's a risk premium, walking up there saying, how I'll offer you $373,550. But certainly equivalents have basically been around for a long time. It's the way in which economists started thinking about risk aversion. One of the most famous experiments of all time. A guy called Daniel Bernoulli tried this experiment where he offered people the choice of a gamble, and he noticed that people were consistently paying less than the expected value. 400 years. So everything we know about risk aversion started with the experiment of why do people not pay the expected value? The answer is, it's because they're risk averse. That's what's built into the risk and return models of today. So I'm glad you asked the question because in a sense it lays the foundations for how we think about risk. So that's the basis for intrinsic valuation. Let's set up the equation. When you sit down to value a company, you have to make a choice. It's actually a choice I talked about in the context of capital budget. You have to decide whether you want to value just the equity in a business or the entire business. Sounds like I'm playing with words, but I'll come back and illustrate why you can get very different answers. So let's play the first game. Let's suppose you want to value just the equity in a business. And you're going to wear blinders. So you look at the cash flows that equity investors get out of the business. What are those cash flows? The cash flows left over after interest payments, after principal payments. You discount those cash flows back at the cost of equity. The same cost of equity we're talking about all this time. What you get as a present value is the value of the equity in the business. In fact, if you think about buying equity in a publicly traded company, historically, what's the only cash flow you actually saw coming to you from the company? Dividend. The dividend discount model is a special case of an equity valuation model. You take dividends, you essentially discount them back at the cost of equity. But you can already see the problem with using the dividend discount model after our discussions of dividends and potential dividends, right? Because you as a company can choose not to pay dividends even though your potential dividends are $3 billion. Think of free cash flow equity as a more generic version of a dividend discount model. We're replacing actual dividends with potential dividends. So that's one choice. Keep everything focused here. Here's the other thing you can do. Rather than look at just the equity in the firm, you can look at the other claim mode. You know who the other claim mode is? You can raise cash flows from equity. You can also raise cash flows from debt. Equity investors got free cash flows equity. But US lenders got cash flows too, right? Interest payments, principal payments. If I look at the collective cash flow you made out of this business, the pre-debt cash flow, that's called free cash flow to the firm. It's still after taxes. It's still after reinvestment, but it's before debt payment. So for most companies, the free cash flow of the firm will be higher than the free cash flow. To discount those cash flows, though, I can't use the cost of equity because that's just the equity investor's cost. I've got to take a weighted average of the cost of equity and the cost of debt, which after a corporate finance class should be, the second nature, it's cost of capital. Cash flows to the firm discounted back at the cost of capital gives you the value of your operating assets of the company. That's a strange middle point. And what's about, you still have cash and cross holdings in other companies, but you're valuing the entire business. it's a very different way of thinking about valuation because you expand the discussion. You think, which one should I use? I'll give you the easy answer first. The easy answer is you should get the same value for equity. If you value equity directly, or you value the firm and subtract out debt to get a value of equity. But you should use whichever is less work. In most companies, valuing the firm is a lot less work than valuing equity because bringing debt payments and issuances into cash flows is a lot more work than changing the debt ratio in your company. But this is a choice you got to make early because everything you do in the company is going to be driven by that choice. So at least let me set up the process for thinking about which cash flow to this. If you're really lazy, of course, you're going to say, I'm just going to use dividends. Right there. Why would I want to go estimate that? And a lot of people do. They look at dividends. In fact, some of them augment dividends with stock buybacks, and that's their end cash. But if you've gone through the dividend section, you can already estimate potential dividends. So you can use that as your second measure of cash flow, potential dividends. And if you want to look at pre-debt cash flows, you can always do that as well. If you have a company with a debt ratio that's stable over time, remember there is a shortcut for free cash flow equity where you get net income minus net capex and 1 minus the debt ratio. So for those companies, you could probably get away doing equity valuation or firm valuation. They're both equally equal. But any company where leverage is shifting over time, which would be 95% of companies, that will either go down or go up, you're probably better off using a firm valuation approach. It's easier to do. Yes.
And in that case, even if the debt is stable, when we have
The debt ratio
the debt ratio is stable.
The debt will actually change over time because the company is growing, the dollar debt will actually increase.
But that doesn't compute potential changes in interest rates in the future. So for example, like
Neither model does. Neither model does, right? Because the interest rate changes, not just the cost of debt that changes, so the cost of
but that's embedded in our
cost of capital, right? You get to pick the cost of capital. It doesn't have to be the same number every year. So if you want interest rates to change over time and default spreads to change over time and betas to change over time, you have the freedom to do that. Because nowhere in discounted cash flow valuation does it say you have to use one cost of capital across time. In fact, I'm going to argue that you should almost never do that. The cost of capital can and should change over time because everything can change. And it's not just interest rates. Your default spread can change as you go from small to large, as you go from growth to mature companies. So we're going to open the door to your specific cost of capital. That's something you don't do in capital budgeting because you're looking at individual projects. With companies, you definitely should. So I'm going to add one more final layer of evaluation. And this is something we spend a lot of time talking about in the valuation class. Now, one of my regrets as I've watched valuation evolve over the last 40 years is how much it's become financial model. You ask people to value companies, they pull up a spreadsheet, they start forecasting line items. And I think they've lost the script along the way. So I'm going to make a statement about valuation that I'll come back and back. A good valuation is a bridge between stories and numbers. I repeat that again, it's a bridge. What does that even mean? If I show you my valuation of Twitter from last week, and you look at my revenues in year 10, my revenues in year 10 are about $11 billion. They're right now $5.5 billion. Here's the question you need to ask me. How do you explain the 11 billion revenues? And the answer I should give you shouldn't be I used the 30% growth rate for the first 5 years because it tells you absolutely nothing, right? I need to tell you my story for Twitter. How it will evolve over time that explains the 11 billion. That they find a way to break the code on how to advertise on this platform where it's very difficult to advertise. That they will find a way to have an augmented subscription or a subscription program where at least the people who tweet the most will have to pay a subscription fee to be able to do that. But I need to tell you a story that explains the 11 billion. When you see my margins in year 10, they're 25% per Twitter. If you ask me why they're 25%, again, I need a story. My story would be Facebook makes 40-45% margins, but it's a dominant online advertising company. Twitter will always be a secondary advertising company in the sense that no company can afford to advertise just on Twitter. They have to advertise somewhere else on Twitter. And therefore, I think Twitter's margin is low. You might not agree with my story, but every number in my valuation has to be backed up by a story. Conversely, every story you tell me about a company has to be in the number. Think of the stories here about companies. That company has incredible management. Okay. Where does it show up? It's got a very loyal workforce. Amazing. But where does it show up? I know you're being incredibly mercenary, but valuation is all about converting stories to numbers and numbers to stories. A good valuation is a bridge between stories. Each of us has a strong side and a weak side. I'll tell you what my strong side is. I'm naturally a numbers person. I had to teach myself storytelling. But I'm glad I did. When I started, it was like pulling teeth. I hated to do it. I wanted to get into the spreadsheet, compute ratios, put in equations because that's what I felt comfortable. But over the last 30 years, I've become a little better. I'm still naturally a number cruncher. I still have to force myself to tell stories, but it's become easier over time. So my advice to you is if you want to be able to value businesses, don't become an Excel ninja. Don't become an Excel ninja, because anybody can become an Excel ninja. Focus on your weak side, because you need that combination. So let me lay out the inputs that are going to drive the value of a company. We're going to start out with cash flows. And let's not get ambitious. Let's get the cash flows from last year nailed down. Take the most recent year financial statement, maybe the last 2 or 3 years, if you want to get a sense of normalcy. And compute your cash flows. Those cash flows can either be after debt payments or before debt payments. After debt payments, you've already done the work, right? You've done the free cash flow equity for your dividend policy. Those are cash flows after debt payments. But since you got those numbers, you might as well use the same numbers to come up with cash flows before debt payments. Free cash flow equity, free cash flow firm comes right under the estimated growth rate. The key word is estimate. Nobody knows it. You can't ask somebody else. So don't go looking for guidance here that's going to give you a number you can use. You got to make your best judgments on growth. And with that growth, you got to think about how much will you need to reinvest to get that growth. That growth can either be in equity income if you're doing an equity valuation or growth in operating income. You're valuing the whole company. Your discount rate can either be a cost of equity or cost of capital. And by this point in time, when you're valuing the company, you already have those numbers because you've computed those numbers when you did the investment analysis and again capital structure. The nice thing about doing valuation at the end of a corporate finance class is you've done all the dirty work already. You got the free cash flow equity, you got the cost. It's just bringing them together in a different context to value the company. And as I said, the closure here comes from assuming that at some point in time, your company will become a mature company. So what I'm going to do is take this structure and use this to kind of talk about my company, my 5 companies, value each of them using a variant of this model. I'll close today's session by talking a little bit about cash flows. So be very careful when people talk about discounted cash flow model. This is a generic term. Push back there. What are the cash flows you're discounting? Because here are your choices. You could be discounting just dividends. It's a discounted cash flow model. The dividend is your cash flow. You can discount dividends plus buybacks because you think buybacks are now a very big part of how companies return cash. Think of that as augmented dividends. Or you can discount potential dividends, which is your free cash flow. So free cash flows equity can take any of those 3 forms. Cash flows of first, always take one form. Now you can break this down into more detail, but free cash flow to the firm is always going to start not with net income, but with after-tax operating. And think of why. Net income is after interest expenses. You want a cash flow before debt payments. You want to start with operating. Of course, you still have to pay taxes. You still have to reinvest money, net capex and change in working capital. But free cash flow to the firm is a pre-debt cash flow. Free cash flow equity is a post-debt cash flow. In fact, with Deutsche in 2007. I did use a dividend discount. In fact, pre-2008, if you gave me a bank to value, I always used dividend discount. You know what? Estimating free cash flow equity for a bank was really, really, really difficult to do. So it's a sign of desperation. I don't know what capex is. I don't know what depreciation is. I don't know what working capital is. But when you use the dividend discount model, you're trusting managers to pay out what they can afford to pay out. And last session, I talked about why that trust is now gone. So I gave you my measure of potential dividend for a bank. And Deutsche in 2016, when I valued them not based on dividends, but on potential dividends. And just as a reminder, the way I got the potential dividends, I started with net income. And then I subtracted out reinvestment, but my measure of reinvestment for a bank was how much does this bank have to reinvest in regulatory capital. In the case of Deutsche, because they were undercapitalized in 2016, the amount they had to reinvest in regulatory capital was large enough that their free cash flow equity didn't just drop, it became a big negative number. This is an advantage you get when you use potential dividends if you don't get the traditional dividend discount. If your bank is undercapitalized, what's the lowest dividend you can have is zero. So basically say, oh, it's zero, that's the worst. It could get far worse than zero for you as an equity investor because you have negative free cash flow equity. The company has to go out and raise fresh equity, which is going to dilute you in the future. That's built into my free cash flow equity model. So when I value Deutsche next week, I will on Wednesday, I will actually value first in 2007 with the dividend discount model. You can see the traditional model, but in 2016, I'll value it with the potential dividends. And you're going to see a very, very different picture. It might be a more realistic picture of a bank when you bring in free cash flow. So let's stop there. And when we start back on Wednesday, we will start back on growth rates and discount rates. But we've done the bulk of the work already by the time you get to that point. As you get the numbers for your project, if you can enter them into the master set, you can wait and do it on Saturday. I think I need to have them by midnight on Sunday because I need the numbers for the Monday presentation. So it's close enough to the actual project review that you have the final numbers. So I'll send you a reminder again for the numbers.
I've got a study room.